Hello, everybody. My name is Bob Klesaas. Welcome to our third quarter 2014 webinar. Our newsletter is titled this quarter, Uncertainty Rises, basically takes a toll on the overseas markets. And when we look at kind of the way we do our newsletter, we mimic our newsletter within our webinar. And in the upper right-hand corner of your newsletter is Bob's Corner. So we talk about the overseas markets getting cheaper. That's the type of buying situation that we like because we're value managers. If you look at over the last 6 years, the market's been basically on a tear, and those 6 years basically create a really hard time for value managers like us to outperform. So we've underperformed, but as we speak, with the markets have been pretty volatile here. The first part of the fourth quarter, we're reaping our rewards right now. What would you buy is a question that I have for you today. Would you rather buy a domestic stock that's about 25% above the peak in 2007, or would you rather buy an international stock that's somewhere between 25 and 40% undervalued? So again, a big question to investors out there is, do you want to be a value money manager or do you want to be a growth manager? As value managers, we're really always looking for that better buy and being a contrarian. If we look at the market view right now, overview, excuse me, is entitled Investors Seek Refuge in the US Dollar. And really there was a flight to safety where money went into the US market and bid up the Dow and the S&P 500 to slightly positive numbers when everything else was really negative domestically. Small caps were down and obviously negative on the foreign side. So the U.S. stocks, because of this flight to safety, because of all the geopolitical concerns and problems in Russia and tensions around the Middle East. So throughout the whole scenario, GDP held up pretty well, though. When we look at the second quarter, it was 4.6%. Estimated for the third quarter is going to be right around 3%. So from that perspective, we did pretty well. Part of our market overview, we have to mention Europe, and European central banks decreased interest rates twice. Again, a sign that the economy is struggling over there and they need to try to bring back some growth. Euro currency also declined, which is good for U.S. investors when we exchange that currency every night from euros to U.S. The U.S. economy, again, looking forward, we've already talked about these numbers. Second quarter was good. Third quarter, estimated about 3%. Job growth at 200,000 a month has really been the average year to date. We need about 220, so the numbers are a little bit under what we need. Unemployment, however, has come down from about 6.1% to 5.9%. Inconsistent housing recovery. I think it's going to be an ebb and flow depending on where interest rates are. Most of the people that have refinanced, so the housing side of the world, mortgage side of the world, excuse me, is kind of going dependent more on the buying of new homes or the buying of your first home or second home. So I think that that's going to be ebb and flow, pretty sensitive though. Business spending is up. That's a positive thing at 8.4%. And inflation is pretty much under control. We've seen a recent drop in energy prices, which is phenomenal. Gives an opportunity for people not to put that money into the gas tank, but to be able to buy more milk and groceries or toys and goods and services. If we look at the U.S. economy going forward, I think there's more volatility ahead, and the big reason behind that is I think the Fed's QE3 easing right now is going to come down to zero. They did $85 billion a month in economic influx to the dollars into the economy. That has backed off about 15 billion a month now for the last 6 months, to the point where right now we're at zero at the end of October. So a big question will be, can the economy stand on its 2 feet, on 2 feet? The other thing is midterm elections. What are they going to do? Big question mark, right? Who's going to have control of the House or Senate? Fed hopes to keep interest rates low throughout 2015. So there's some positives, I think, in the economy looking forward. We have a healthier job market. Could it be a little bit better? Yes. But consumer spending is up because of the jobs. And business spending is on the rise, which again, we've lacked in our two previous attempts on quantitative easing to get the economy rolling. How about the bond market? We really had mixed returns on the bond market, and as interest rates fluctuated, we saw domestic bonds fairly flat to slightly positive. We saw the Barclays aggregate, domestic aggregate at 0.2%, the U.S. government bonds at 0.3% on the 10-year. The 20-year government bonds, 2.6%. Corporate high yields were -2. International bonds, -3 on the global index for Barclays, and emerging was -0.6. So again, not the greatest time period for bonds. However, bonds are doing really well, obviously, as we speak, the first 15 days of the quarter, fourth quarter, based on the fact that our domestic stock market and international markets are reeling right now. So looking forward on our bond portfolio, consensus is that rates will go up higher if the economy continues to strengthen. 10-year treasuries could reach as much as 3.5 in 2015. Fed wants to keep the yield curve pretty flat on the long end to keep interest rates low, keep the economy benefits with that interest rates lower on the long end with housing. Emerging and corporate are still probably the best buys, most attractive. And you probably all heard the PIMCO departure of Bill Gross was a significant influence on what the bond market did for this last quarter, and how one person can do that is amazing. But again, when things were going kind of rough for he and his ex-firm, PIMCO, the markets reeled on the bond side. If we look at the domestic stock market, large caps were up, but other things struggled. Remember, I talked about the flight to safety was really a result of the fear that was being driven by geopolitical and other problems around the world. So what we saw is a mixed bag. The Russell 3000, which is 98% of our value in the U.S. is in these 3,000 stocks, was up 0.1%. The large caps 0.7 on them, mid caps -1.7, small caps -7.4, large caps 1.5 on the growth. Large cap on the value was actually slightly negative. So in a very, very volatile time period, large outperformed small and mids. The leading sectors, kind of weird, but healthcare and technology were the worst performers last quarter. Now we're the best at a 5.5 and 4.8% gain per sector. The trailing sectors were the best last quarter, with energy being up, and now it was down 8.6, and utilities down 4.0. So again, we had a flip-flop on what happened in the domestic market from a sector standpoint. So what does the domestic stock market look like going forward? We have better value today than we did at the first of the year. Even though the market has not really gone anyplace, it's been pretty neutral to slightly negative for the year. Earnings have risen, so from that standpoint, market flat, earnings risen. The valuation of the market has improved. The Fed is going to continue to ease interest rates, keep interest rates low for both consumers and corporations, and I think that that's going to be a positive. Business spending is up. The buyback of stock, the merger and acquisitions, all good for really the stock market. Corporate profits are also up. Again, so there's a lot of positive things heading into this fourth quarter, with some of the negatives being, and I think the biggest negative is that we're just right now at a 6-year bull market. Are we due for a correction? We think we are, and I think we're experiencing that right now. When we look to the international markets, again, they were very fragile. We saw the recoveries dampen of what they did recover in the second quarter. They dampened in the third quarter. Again, Europe is kind of going through a problem with geopolitical scenarios there, as well as their dollar, the euro, falling to the strengthening U.S. dollar. The MSCI EFI index, Europe, Asia, Far East, was down about 5.9%, pretty significantly. Euro as a whole, 7%. Japan was down 2.3%. And again, the EFI is basically a combination of Europe and Japan, Europe, Asia, and Far East. And we saw China negative 3.5%. So what we're seeing today is a European Central Bank continuing to do what we did 12 months ago and kind of got back to the bottom of lowering interest rates. And those lowering of interest rates happened twice to again incite the economy. What do we think is going to happen going forward? I think the uncertainty that we had in the European market, in the international foreign markets, really gives us a volatility that brings an opportunity. And that opportunity is value. So even though emerging has struggled, again, that's a benefit. We think that the euro rates, the lowering interest rates are going to be a positive. Asia is favorable, again, from a valuation standpoint. China and Japan, they're still transitioning on some of the leadership roles, as Brazil and India are also going through some political concerns right now. So really a quick summary, stocks really in our minds remain fairly valued. Foreign is better than the U.S., again, as we spoke to. Equities are better than bonds and cash, except now when the market's going down. And we think foreign markets, are still, we know foreign markets are still under their 2007 high. There's a reason for that, and that's that they haven't moved up as much as the domestic. And for that reason, we think that they're of good value. Returns will not match 2014. It's has the bull run ended is really our big question for you guys, and we think it probably has. What do you do with your old 401k plans was the title of our 5th page of our newsletter, and hopefully you guys will read that. But when you have all of these different types of plans, you want to roll them over, you want to consolidate those for sure. You do have options. You have 4 options. You can leave it at your existing or old employer. You could roll it over into a new employer's plan and still have the capability to have a loan privilege. Or you could roll it into an IRA and manage it yourself, or have us manage it for you. The 4th option, I think, isn't an option, and that's cash out and run. If you cashed out, if you're under 59.5, you're going to pay a 10% penalty. Plus you're going to pay taxes on that entire dollar amount. So you could have on a $10,000 401k that you cash out and pay taxes and penalty on, you could maybe be left with $6,000. So in a high tax bracket, you'd be left with even less than that. So that's really not an option. But our biggest and best option, I think, would be to roll it to an IRA. Let us know if that's something that we can do. On the back of our newsletter, we talk about kind of a restaurant recommendation every quarter, just for fun. The Boulevard Kitchen and Bar, 394 is fantastic. Josiah's Aunt's Golden Pear Soup is also fantastic. Quote of the day from one of our new employees, Carl, came to the table with a John Wooden quote: "The main ingredient of stardom is the rest of the team." So again, we think that favors very well to the team that we have here at All Star Financial. So real quickly, we want to thank you for your continued trust in the All Star team. Remember that your referral program, that you can refer clients to us and get a reduction. Give us a call at any time. Those are our teammates here on the field. We look forward to talking to you with any and all questions. And again, we appreciate your continued trust in the All Star team. Have a great day.